I'd previously been investing in private technology companies in a very low risk way. These were early stage technology companies across the States, Europe and Israel. And we were doing it in the lowest risk way we could, which is quite difficult in early stage technology companies. And that involved understanding the patents and taking security on them and using them as a sort of residual asset value that gave us a floor on the value of these companies, and we use an instrument that gave us some protection. It dawned on me after 11 years and never having a down year and a good track record in this that there was a much less risky way to do this with probably less risk and better returns. And that was to invest in more and more of public technology companies whose products were already out there, their balance sheets were pretty clear, their whole business models had been sort of approved, they were listed. As when you think from a value investor's point of view, very occasionally on the stock market you get these moments where you can buy companies at close to their asset values or some perceived discount to those. When you're in a private market, you're often negotiating with other skilled professionals directly, and so you have less opportunity sometimes for mispricings in that sense. And it dawned on me, the other thing is these public companies have less business risk in them. 1/3 of all venture investments fail. So we realized, and because I'd been involved in investing in patent-backed companies, both public and private, 10 years, something happened a while back as the US Patent Office digitized all the records for patents everywhere in the world. And I realized then that one of the key, when you look at the balance sheet of a company under current accounting conventions, if it's a property company, they put their buildings on their balance sheet. If it's a manufacturer, they'll have their book value of their plant and equipment that allows them to produce goods and charge whatever margin they charge on that. Tech companies, because patents are difficult to value, unless you purchase them, if you create them yourselves, they don't appear on your balance sheet. So you take a big drugs company that's created a lot of its own patents, look at its balance sheet, it really doesn't reflect the assets that are generating the cash flows. And as you think as a value investor, the reason patents are interesting, they're legally defined monopolies. So instead of, most value investors quite correctly want something that's stable, monopolistic type barrier to entry for their economic moat to protect their ability to charge reasonable returns. And tech companies do that by way of patents. It's not the same. So it dawned on me that the bit of the balance sheet that was missing or difficult to understand was this, and the costs of finding out what people own had shifted when you digitized the records. So imagine trying to invest in property companies when you didn't know which buildings they owned. It would be a more complex business. So it was on the back of that, we actually ended up had to build a database, which is possible, and that links all the patents in the US Patent Office to basically most of the companies that own them, and then also the reassignment data. When a company acquires another company, you reassign your data, you sell some patents. So you've got to keep, this is a moving thing, you've got to keep track of it. And innovation is also always moving, so within any technology there's a technology cycle time. So just sheer innovation drives stuff. So you have to keep track of the relative ownership and the merits of various patents. And then you rank them and you do various other things that allow you to have some estimate of, not so much a dollar value, but some estimate of the value of these patents vis-a-vis their competitors. Once you have that piece of a jigsaw, when you're investing in public companies, our operating assumption is that the people who are selling us, when we're buying a share, probably everybody around the table knows more than we do about that company. They may know more about their future earnings. We don't necessarily look to future earnings, we're looking more at the balance sheet. So that's our edge, and we were trying to really spend our time on that edge, make sure that we felt in that area we had more advantage than the people we were either buying or selling shares to, so we would have some edge and we could apply. And The other subtle point about that is, or more subtle is, there aren't many, for very good reasons, value investors in tech companies, because it's very difficult to look at the balance sheet unless you build your own database, or you can go and pay consultants to dig it up and look at it vis-a-vis the competitors. So there are ways and means of doing it, and there are plenty of funds who do that. So that was really, it came from a background of having invested in these companies privately, and it dawned on me that actually there were much bigger companies, 600–700 million market cap, with products in the market, who very occasionally, in the value investing sense, Mr. Market gets completely wrong, and it's normally one of 2 or 3 factors. Either normally just a big market bust, when there's indiscriminate selling, and you can find companies that have exceptional intellectual property positions that allow them to extract economic rents, and you can buy those at prices you think don't reflect the value of the franchises and their ability to extract these monopoly type margins at the time. Then sometimes you have a whole sector that becomes very unfashionable. Sometimes healthcare. Hillary Clinton, when she was reviewing healthcare when Bill Clinton's first presidency, I think the whole healthcare sector was under a cloud for a while. And occasionally, if you're patient, and again this brings in you have to think in value investor, as long as you're patient, the assets look mispriced for their long-term ability to generate cash flows. And then occasionally, just within a specific company, something goes wrong. And that's the third scenario where we tend to find we're picking up companies. And it involves a degree of discomfort, because we're relying, it will be some corporate disaster, some subsidiary does something, misses its earnings or blows up or something, that leads to a general rejection of the company. And we're then against the human instinct, which is when you see these corporate disasters, you think it's not necessarily the natural instinct to buy, but what gives us confidence is that, especially in tech companies, is we can see there's this residual value, this flaw that we know is valuable not only to the company but probably to other people, and it gets recognized in one of 3 ways. Normally, if it's not often acquired, another corporate buyer who can assess the value of those assets because they're in the same field will look at them and say, we think that we can purchase those by way of a merger and acquisition that helps their business. Or if that doesn't happen, often you get activist investors. We're not an activist investor, but we often end up, we find, in companies that are unpopular, but then all of a sudden an activist investor appears 10% of the company and agitates to get the management to realise value from that asset. And thirdly, the company often just gets re-rated by the market as the cash flows appear or the problem's sorted out. So we need these dislocations. We're often, to get into companies, it's that Mr. Market dislocation drives the confidence we have to buy these things when other people aren't buying, which is inherently uncomfortable, I think, as a human trait, is really looking at the balance sheet and saying, and the subtle point here is that the people we're competing against, we assume, can't necessarily get as much confidence as we can around the value of those assets that provide really a floor on the price at a time. It doesn't mean we don't experience the usual process of value investing, which is you buy it, it gets cheaper, you get a bit upset, and it gets cheaper and you buy some more. We're subject to all the usual vagaries of that, and that's part of the process. The issue for us is this confidence around the asset values. So really, I think none of our investment models or how we look at companies involves trying to forecast the earnings particularly. We're really trying to base our thing on what are these assets worth to another informed buyer, and are we buying them something that generates cash flows at a discount that provides a degree of safety to us. And that's, in one sense, very simple. I mean, I think the analogy I'd say is you look at the proportion of cash flows of the US stock exchange that are now generated from patents vis-a-vis 20, 80, 50, 60 years ago. More and more the discrepancy between book value and market value has increased since the 20s. A lot of that's to do with cash flows now coming from intellectual property, be they brands, be they whatever, and that issue has to be addressed. You can sit there and say, well, patents are difficult to value, we're not going to invest in tech companies. But at some point, you have to start to get your head around the actual assets that are generating the cash flows. And you can do that in probably every industry. Technology, you can do it, but you either have to be very specialist or spend a lot of money. And it changes as well, which is why most value investors, if you want to hold your asset forever, you own Euro Disney or Disney, and they have a theme park. That's an economic moat. It sits there until it's going to take quite a lot to change that. Unfortunately, you can't do that in patents, and we'll come on to some of the large companies, because just sheer innovation drives through all the time, which means you can't hold the assets for infinite periods, because actually just innovation eventually moves through. And I think we can talk about Nokia later as an example of a company that just pure innovation gets around them. So that you need to be aware of that. So that while you can do value investing in tech companies, you need to understand the balance sheets, which are opaque and they're not transparent. You have to do your own work there. And two, you have to know that your portfolio isn't going to be, you're not going to be able to hold things for 20, 30 years, because there is a huge amount of innovation. But that's fine too, that makes it more difficult for other people to figure it out, and you have to move. But compared to most tech investors, who are to some degree momentum investors, they're trying to guess the next set of earnings, which is probably correct for all those companies. We don't play that game. That's not what we do. So that's quite nice, because we're playing a slightly different game, where a lot of the people we compete against in the market valuing these companies are doing something different, which gives us opportunities as well.